Hello everyone, welcome to today's teaching and hope you guys are all good. So today I'm going to be covering higher time frame series part 2. Last week I dropped the first series of higher time frame analysis covering IPDA data ranges. I don't know why I keep saying IPDA data ranges. IPDA ranges because data is already in D in IPDA. So last week I dropped video covering IPDA analysis, and I was unable to check the Telegram chat basically to see if there were questions regarding the video I dropped, but I expected that everyone who watched the video was going to ask the educators if they had any issues with what I said on the last video. And so far, so good. I'm going to accept that last video was basically okay. And before we go into today's video, I just want to make a quick disclaimer to you guys. Okay, so what I'm going to be teaching you guys from here on is going to be deep things, right? And it's going to be a lot of things which most people are not exposed to, who think they trade institutional or who think they are institutional traders. Okay, so many people are not really aware of this, and because I checked the Telegram channel and I was looking at the number of views on some of my videos and some of my chat works on the channel, and many of them had views that were way higher than the one we had on the number of subscribers we had on the Telegram channel. Okay, so that means someone is sending out my content to other people, which I'm not comfortable with. If you want to send out my content to anybody, make sure you ask me first, because the reason why I'm not doing content for the free group that really for other teams, because I want to keep this between ourselves. Okay. I want to focus on our team. I want to focus on you guys. And in a situation whereby I'm teaching you guys stuff and then people are sending out what I'm teaching to other people, that we no longer have the integrity of our group, and then people are basically getting value that you're paying for. Okay. So you got to think about that. People are getting value for something you're paying for. If they want to get that same value, they need to pay for that. They need to be ready to sacrifice to get that, to get the value. Okay. So with that being said, hopefully from now on everyone cooperates with uh, terms. You don't have to send my content to people. My content, noise content regarding videos or chart works, and even Bailey's content also. So basically, any educator from uh, Forest Cartel, I don't want you sending content out except you ask for the permission of any of the admins. Okay, so with that being said, let's go into today's video covering higher time frame analysis series 2. And today I'm going to talk about open float, and specifically I'm going to talk about open float around quarterly shifts and higher time frame levels. Okay, so now talking about open float, you know what we do on higher time frame is all institutional. We're all trying to understand the levels where price is being drawn to, and then the levels where price is reaching for. Okay, and this is only going to happen based on where the money is in the marketplace. So the price on the higher time frame is going to move around based on where the money is in the marketplace, and the money is usually going to rest around higher time frame levels. And money is going to rest around higher time frame levels in form of open float. All right, so now that brings us to the definition of open float. So what is open float? Open float in the marketplace simply is the current open interest. Okay, current open interest meaning the current running orders in the marketplace above and below market price, current market price, CMP. Okay, so I'm going to repeat myself once more. Open float is the current open interest. Current open interest can also be translated into the current orders running in the marketplace above and below current market price. Okay, so open interest is going to come in form of pending buy orders resting above old highs, and pending sell orders resting below old lows. Okay, so I want you to think conceptually. Okay, conceptually. Right. So, if you understand from what I've been teaching you guys for like the past couple weeks, that people who trade hedge funds are basically retail traders who still have the same retail mindset that you and I do have, and a lot of other people trading as retail traders do have. Okay, where is your orders going to rest? And if you also understand that hedge funds manage huge amounts of capital, right? And they're basically trend following in nature. What is that going to tell you? That means if you're going to seek bullish moves, the safest way you're going to place that order is by placing buy stops above old highs. And if you're looking for bearish moves, the safest way you're going to place the sell orders is by placing sell stops below old lows. Okay, so generally the action of all these entities, all the different hedge funds, all the different market players, the big market players. Now, I'm not talking about the small retail traders. I'm talking about the big market players in terms of hedge fund institutions and all that. The total action of all these players in the marketplace is going to lead to open flow, because it's going to be different orders coming into the marketplace at different times in the market. But now, price is only going to seek levels where there's a general, okay? I want you guys to take this on your notes. By the way, if you're not writing, I want you to pause this video, go get your notepad, get your pen, and then go back to the beginning of this video and restart this video and start taking note of what I'm saying. This is going to be very helpful with understanding Chelsea patterns on higher time frame, understanding daily levels, understanding rejection blocks, understanding old highs, and also understanding old lows. Okay, so what is generally going to happen is there's going to be a collection of retail orders, not retail orders now. So let me rephrase. There's going to be a collection of institutional orders. Okay, now when I mean institutional orders, I'm not talking about the central banks. I'm talking about hedge funds, talking about people who manage other people's money, okay? And I'm talking about large commercial players in the marketplace. So there's going to be a general, there's going to be activity from these guys, okay? And that is going to lead to a general collection of pending orders in the marketplace. So that is going to lead to pending orders in the marketplace. And also, is going to be running orders in the marketplace. So just two things: pending orders in the marketplace and then running orders in the marketplace. And generally, the way every single person who trades think is either I place my stop loss above old highs or below old lows, or I place pending stop orders, okay, for activation above old highs and also below old lows. So this is the way every single person coming to the marketplace thinks. I just want you to think for a second. If you're placing a trade, where do you place your stop loss? Below old highs, definitely. Okay. Now, in your case, it might be short-term highs because you don't have enough capital to handle the drawdown on higher time frame. But now, the same people who think the same way you do also manage hedge funds, right? And they're using monthly time frame, using a weekly time frame, using daily time frame because they have huge capital to trade. They can handle huge amounts of drawdown, 200 pips drawdown, 300 pips drawdown, 50 pips drawdown, okay? So these people can handle that amount of drawdown, right? And then what you're generally going to do is, if they are in a current trade, you're going to protect that trade by placing stop orders above or below above old highs and then below old lows. That the general collection of hedge funds, institutions, commercial investors doing the same thing is going to lead to a pool of liquidity in the marketplace. And this pool of liquidity is generally going to form around daily highs and daily lows, above daily highs and then below daily lows. This is how the market is going to trade, right? So as price moves from one level to the next level, it's going to be a general pool of orders floating around highs and lows in the marketplace, especially on the daily time frame. Okay, and this daily time frame levels, what is going to rest around those levels are the hedge funds and the institutional liquidity pools. That is what is going to rest around those levels. Okay, so the general collection of liquidity pools from these different market players is what leads to open flow. So this is the open flow in the market, which we define as the open interest above or below, sorry, above and below market price, current market price. Okay, so now what then, take bullet points. So bullet point, shorts protective, that is buy stops, are going to be resting above the last bearish shift. Buy stops are also going to rest above short-term highs. Buy stops are going to rest above the highest high in the last 3 months. Buy stops are going to rest above last 6 months high. Buy stops are also going to rest above yearly highs. Okay, so these significant price levels, what is going to rest in there is going to be a general liquidity pool, because these are levels that are very obvious to the human eye. Right, so generally all these market players are going to look at that level as a logical level to place stop orders around that level, which is going to lead to a general collective pool for IPDA to move price into. Now, if you go back to our first video, I talked about IPDA trying to seek liquidity and volatility in the marketplace. So now, how the liquidity forms in the marketplace is by open float. Right, so this is why IPDA is going to seek those levels, because those levels are very obvious levels for these players in the marketplace to place orders around that level, be it stop orders, protected stop orders, or market limit orders around those levels. This is what those players are going to do in the marketplace. And then IPDA is generally going to want to drive price to that level, and the central banks are going to look to capitalize on those moves that IPDA is doing. Okay, so I'm going to recap a bullet point for buy stop. Okay, so short protective, which is buy stop. Remember, if you're selling, you're going to have buy stops above current market price, which is going to be above an high of some sort, which might be a 1 hour high, 4 high, daily high, weekly high, monthly high. Regardless of what we're focusing on this series is only higher time frame levels. Okay, monthly, weekly, daily. But now if you're looking for stop price, you're looking specifically on the daily level, because this is the time frame that all these players in the marketplace are using for protective stop losses. Okay, they're not using the monthly, not really, mainly using the daily levels for protective stop losses. And these are very, very juicy levels for IPDA to drive price into, either for a solid soup or as a price target objective. Okay, so buy stops are going to be resting above the last bearish shift. Buy stops are going to be resting above short-term highs. Buy stops are going to be resting above the highest high in the last 3 months. Buy stops are going to be resting above current 6 month high. Buy stops are also going to be resting above the yearly high. And then the same thing goes for sell stops. Sell stops are going to be resting beneath the last bullish shift. Sell stops are going to be resting below short-term lows. Sell stops are going to be resting below the lowest low in the last 2 months. Sell stops are going to be resting below the current last 6 month low. And sell stops are going to be resting below yearly lows. These are very, very significant price level that everyone generally is going to look at, which can be levels for a general collective pool of traders in the marketplace where others is going to rest. Okay, so now let's go into practical examples. All right, so I know for like the last 20 or so minutes I've been talking gibberish, giving you all theories. You guys all need practical, okay? So going to show you how general collective liquidity pool forms in the marketplace. All right, so we're looking at GBP USD. This is our daily time frame on GBP USD. I'll just watch this quickly. And I just want to bring your attention, guys, quickly to what we're seeing on our chart on pound USD. So I'm going to start with price action from the 14th of August 2018, which was last 2 years. Yeah, that's me. All right, guys. So just a quick note: if you hear me coughing during this webinar, that is because I'm suffering from cough, which I'm treating myself for. So please do bear with me. Hopefully this gets fixed soon. Right, so I'm looking at price action from on a pound USD from 14th of August 2018, and I just want to point your attention to what I just mentioned about open float in the marketplace. Okay, so if you look at the market from around this level, you can generally see that the market is on a downtrend. Right, so the market is creating lower lows, lower highs, lower lows, lower highs. So we know the market is in downtrend, right? Then the market then shifts bullishly and takes out the last high in the marketplace. Okay, so there was a shift bullishly around this level, and that was for about a, let's see, a 40-day period, which is 40 to 60-day period, which is a 3-month period. So this is classed as a quarterly shift bullishly on pound USD because the market shifted for about 2-3 month period, which generally is the time frame for the market to shift when you're looking at quarterly shifts in the marketplace. Usually about a 2-3-4 month period in the marketplace. So this can be qualified as a bullish shift in the marketplace. And I just want to point your attention to the range created in this marketplace, right? So there was a range low when price shifted bullishly around this level. Let me quickly edit this line to make it black. Okay, it's black. Straight. All right, so the bearish low was created around this level, and the last high when price shifted to the bullish side was around that level. So I just want to point your attention to the way price traded around these two sensitive price points, right? So the market started to shift upwards. Now, for some reason, it's going to be hedge fund traders and commercial investors looking at this as a shift higher in price, right? So the market has been shifting for about a month, going into 2 months, and this will be a likely retracement back into these levels. And then people are looking for the safest way to buy this market. What you're going to do is there's going to be where buy sells above these high. The high formed around 25th to 27th of July 2018. That is the last significant high. Everyone can say this level because it is a very obvious level. And if you look at open float, I mentioned that open float is going to form around very obvious daily levels. Okay, so make sure your attention is drawn to that. Very obvious daily levels. So now, when people begin to see all this, there's going to be a collective pool of orders forming around this level, right? There's going to be lots of buy stop orders forming around this level because people think once price breaks through this level, it's just going to keep shooting up. Okay, so there's going to be a large pool of orders being formed around that level. And to indicate that, so that you guys don't forget this, I'm going to make this green, right? Let's make this green. So around that level, yeah, so I want to make it like this. Let's look on this. So we expect there's going to be money being formed around this level, huge amounts of money being formed around this level, because people are looking at this as a breaking structure and the market wants to trade higher. Right, so it's going to be money being formed around that level. And now, if they are placing orders around this level, where will the protective orders be? Right, now you have to refer back to where was the bullish shift in the last 3 months? This level. Okay, so I'm drawing your attention to that level. There's going to be hedge funds protecting their buy orders with sell stop orders below this level. Okay. So to give you a concept of that, I'm just going to do this. The way the hedge fund will look at the marketplace is they're looking at this as a break in market structure, looking for higher prices, probably to around this level. For some reason, you're looking at prices shifting up to this level. Then you're going to want to protect your stops or your orders beneath the last bearish low, because they feel if this was the point of origin for this bullish move, the market should not trade back to this level. This is why this is going to be a logical level for them to place the stop loss around, and then you're going to see higher prices. Why? These people are trend following in nature, and they can handle a 485p drawdown if they don't expect that level to get hit. Okay, because they have huge amounts of capital, right? So that is then going to form another collective pool of orders, sell stop orders in the marketplace below that level. Okay, so money is not going to be formed around these levels. Money is going to be formed around these levels, right? Then what is IPDA going to do? IPDA wants to drive price to where the money is. Where is the liquidity in the marketplace? That is where IPDA wants to drive price into. So what IPDA then do is drive price into the last old high, right? Quickly shifted away from that level. Look at this huge down candle. Okay, there was a huge down candle, market shifted down, and then the market starts to trade downwards, right? Market starts to trade downwards now, and all these people are trapped around this level. Hedge funds are trapped around this level. They still think the market is going to trade higher, right? If you draw a trend line around this level, there's reasons why you can expect bullish prices, right? Market is respecting this trend line, respecting this trend line. So they want to see price trade higher around that level, right? So everyone is still thinking, okay, it's not yet time to panic because the market wants to trade higher. These people are trend following. So the market still creates higher lows around this level. There's no reason for them to be concerned yet because the market has not shifted to the downside, right? But what IPDA then does is to what? Drive price once more into this level, giving a failure swing, and then shifts to the last 3 months level, taking out effectively liquidity below this marketplace. Okay, so the market basically traps buy side liquidity, comes down back to last 3 months low, which is our quarterly shift bullishly, and takes out the liquidity in the marketplace. This is typical price taking out IPDA ranges. Okay, so what price did was to take out IPDA ranges. So I'm going to give you guys one more example before I call it a close on this video. So now let's see what price is doing. Once see price create a range. Also, we have the benefit of hindsight, so that is very helpful to our cause. We could look for very, very neat examples and see what price is doing. All right, so I'm going to point your attention to this level. Right, so now you're gonna ask, why, Gene, why are you pointing our attention to this level here? What is special about that level? Well, if you look at this level, right, if you look at this level, price was trading in a range until price broke to the downside. Price broke to the downside below this level. And what did I tell you about levels? Old highs and old lows. She's going to be pending sell stop orders resting below that level. So if these people, I'm talking about the hedge funds now, hedge funds, commercial investors are looking at this level as a potential short level area that they could get short in sync with market structure, then you're going to look at the marketplace like this. They're expecting a breakout of this level and price should trade lower into discount levels, right? And they're going to protect your levels by placing your protective stop orders above the last daily level, the last daily high. Okay, that is this level. So protective stop orders are going to be placed around the last daily high, right? And then look how when price broke down, price quickly pulled away and reached for this level. Price is reaching for that level because there's going to be money resting around that level in terms of the hedge fund protecting your stop losses, protecting your trades with the daily old eye, because you're not expecting price to trade back into this level. They think price is trading down. So these also constitute open flow in the marketplace where price seeks daily levels. Now you can see when price shifts to the bullish side, price comes down to seek liquidity resting below this daily low, because there's a daily low around that level. And if you look at this level, this basically is a, let's see, January to all the way down to this level. So that basically is a total suit buy setup, okay, for long opportunities. The market comes down, takes out the pending sub losses below this level in case any hedge fund was following this move higher, thinking this was a buy move. They took out all the liquidity below the marketplace, and look how they ran the market up. Did the same thing, all right? Took out liquidity below this last daily level. I'm going to draw attention to this level, okay? Below the last daily low, took out that liquidity, spiked down, and look how quickly they traded up into the marketplace. And then basically that is how the market moves. So hopefully this video was insightful to you guys. And I'm looking forward to seeing you guys on the next video, which should be dropping in the next 24 hours. And in the next video, I'm going to be covering PD arrays on higher time frame levels. And those so many of you guys have been anticipating that video, and that is going to be dropped in the next 24 hours. So I expect that you guys look forward to that, and I'll see you guys next time. I wish you guys all safe trading, and that brings us to the end of this video.